All right, I'm going to try and teach class using videos. And if you can remember, we were in Chapter 5. That was on cost, volume, profit. And we had done several exercises. The last exercise we worked was 516. We didn't quite finish it. And after we finish it in this video, we're going to go on to Chapter 7. And I probably will be giving you quizzes online now. So I'll send you an email about that. But anyway, we're on Chapter 5. We're working problem 516. We've already done, it was a problem where basically we were trying to find out break even. Remember, cost, volume, profit, break even. And it was for a dinner dance. Do you remember that? It was a dinner dance. And again, we're going to basically, hold on, I left my marker up here. The dinner dance, we were going to charge people $35 each to go. It cost $18 for each dinner, $2 for the dinner favors, $2,800 for the band, $900 for the rental of ballroom. Professional entertainment was $1,000, and tickets and advertising were $1,300. These all added up to $6,000 fixed, and the variable were equal to $20. Again, $20 is what it cost for the dinner. Now they're charging people $35. The first question that was asked was, what's it take to break even in part 1? Now we did that before we went on break and before this virus hit. And we calculated it was 400 people to break even. That was part 1. What is the break even point? In part 2, they asked, what would happen if you couldn't get 400 people? What if you could only get 300 people? Well, if you can only get 300 people, what would be the price that you would have to charge? So we figured that out in class, and the price to charge was $40. You see, again, it makes sense. If only 300 people attend, you're going to have to charge them more than 35. This was the 35. You're going to have to charge them 40. And finally, in part 3, they say, would you prepare a graph to represent this, a CVP graph? And I started the graph. And I actually am going to erase it just a little bit. I started it, but let me show you again how I came up with this. I'll kind of show you again. This is part 3 again. And to start with a graph, I think everybody would say, well, I know one thing. Draw a left axis and or an x-axis here and a y-axis here. And in accounting, almost always our graphs have money over here. Money. And almost all graphs in accounting have volume down here. And to do a graph, what kind of volume are we talking? Well, volume in this case is people attending a dinner. Again, how many people will attend? I mean, you do have to make some decision. What's your x-axis going to be? What increments? Well, since we know that 400 people are break even and 300 people are what we think will attend, we certainly should have 4 and 300 somewhere in the middle. So let's drop back and say, well, how about I try this? I'll do 100, 200, 300, 400, 500, 600 people. And that's pretty much, you see, that's really where you think you're, somewhere in this zone is where you think your graph, your real data is going to hit. These are kind of outliers. Now, what kind of money? Well, once you've got your x-axis, you can get your y-axis because you know these are connected to money. Do you remember what the money is? Again, over here, we know that, again, if 100 people come, let's just use this. Each person gives us $35, and that'll be $3,500. If we know that the maximum 600 people come, with 600 people, and we get $35 a piece, will be $21,000, I think. Yeah, that looks right. So we can look at that and say, well, I know at the low end I need 35, that's kind of my low, and at the high end I need 21. So again, I need a graph that goes up to about 21,000. So let's just make this. I took this 1, 2, 3, 4. Let's make this 20,000. I don't want to go any higher than that. Let's make the halfway point 10,000. Let's make down here, these are now going by 5, half that way. Half of this is 5. And half of this is 15. You see I've got even increments now going from 0 to 20. I think that'll cover my whole graph. And to begin with, we just want to put, again, how much money will we get? Well, let's do that. We've already got that. We have it right here. At 100 people, you'll get $3,500. Do you see that this is really, basically what I've got here is these are X's and these are Y's. Whoops, this is Y. This is X. And anyway, we said 100 people, it's going to be $3,500. So we can say, well, at 100 people, we will make, oh, about right there, $3,500. That's, again, you know, to do a graph, to do a CVP graph, you need all the money, the revenue line. You need a revenue line. How much revenue will we get? Well, we know if 600 people come, we're going to get 21,000. Let's go out here. 600. We got to go a little bit up here, 21,000. But again, kind of going over 600. And there's our line. I don't know if I have anything to draw a straight line with. I don't think I do. This is not going to work. I don't have a ruler in here, but I can do the best. I know I'm going to draw this and say this is my total revenue line. Whoops, pretty bad. But you get the idea. And we'll call this total revenue. And again, total revenue, and now we've got to come up with a total cost line. Well, let's do a total cost line, and we'll do it in red, but again, what's going to be, let's use the exact same points. Let's do 100 and 600 for total cost. Okay, for a total cost at 100. Well, at 100 people, it cost me $18 plus $2. Remember? That's going to be 18 and 2, 20. That's $2,000. That's for, again, but I also have to add 6,000 to that. You remember? Now, let's think about this. Again, they said, no matter what we do, we're going to have $6,000 in costs. And then $2 and then $20, these two in variable. So I'm saying to you, again, if 100 people come, you're going to need $18 for dinner. You're going to need $2 for the favors, times 100, that's $2,000. But then you'll need $6,000 for the fixed cost. So there's your variable and fixed, that's $8,000. So we can really say that 100, at 100 we'll have costs of $8,000. And again, this is X and this is Y. So let's do 100, and we're going to have costs of 8,000. So that's 10 here. That'll be about 75. There's 8. It's going to be about right there. All right, now let's do one for 600 people. If 600 people come, let's not do 600. Let's do, I can pick any, no. Total costs. All right, let's do 600. If 600 people come, I'll still have $18 for dinner plus $2 for the favors. And that's going to be what? 20, 2 times 6. That's going to be actually 12,000, I think. $12,000 plus 6,000. You remember? Again, you know, we got $20 for every person, 600 times that. That's going to be 12,000, but there's always the fixed cost of 6. So that's going to give me, for 600 people, I'll have costs of $18,000. And that's X and that's Y. So 600, and let's go up to $18,000. 18,000 is right about, there's 17.5, there's 18, I'll come across. And there's 600. Okay. Now I'll do the total cost line. And the total cost line, when I connect these two, oops, that's pretty bad again. But there's your CVP graph. There it is. And again, what you can see here, this distance here is called loss. All this in here is loss. And then up here is gain or profit. All this is profit. And again, do you guys remember that, what, where the two lines meet? That is break even. So they break even at the 400 point. Remember, at 300, we can't break even unless we raise the price. But based on the original data, here's your CVP graph. And again, you might notice again that, do you notice that again the line of total cost, that it really hits here at 6,000? Does that make sense? It hits at 6,000 because cost will never go below 6. You see that that makes sense? even if no one comes, we're gonna have to spend $6,000 on the band, on the ballroom, on the entertainment, and then on the tickets and advertising. So really, again, you see the total cost. Oh, by the way, I should have labeled this. This is the total cost line. And again, as you can see, the total cost intersects the y-axis, again, at the $6,000, which tells you the cost will never drop below $6,000. That's actually your fixed cost. If you wanted to, you could draw another line out here that would show fixed costs, again, being flat. But I'm not going to do that. Anyway, CVP, I don't know what I'll do on the test, but I'll probably put one, maybe two multiple choice on the test at most on that. Okay, let's leave that. And let's go on. That's, again, 3. By the way, that is part 3. Do you see that? This is part 3. Now we got to go on. Let's go on to a new problem. And it's the last problem. It's problem 522. And 522, there we go. Let's see if I can get this up. Alrighty. There it is, almost. Again. All right, I'll lock it in. There we got it. 522 is the last problem, and we're only going to work parts 1 through 4. We won't work part 5. Erase this, all this. And we'll be working 1, 2, 3, and 4. And we're working problem 522. But I think I will go ahead and take a minute. I'm going to get rid of this because I need this space. I'll pause the camera. I think I'll get better and pause the camera. But I'm not going to do it the first. This is my first time on this, so I'm just going to try and move forward. All right. Here we go. This is going to be problem 5-22. We're going to do parts, I don't know what page that's on. That's page 233. That's page 233. And we're going to do parts 1 through 4. And again, let's label this. Let's do this one as part 1. All right, let's go over here first. This is a problem that, again, they make. This is, let me see, due to erratic sales of its sole product, which is a high-capacity battery. Okay, a battery. We're talking probably a battery out of a laptop. Isn't that what it says? Yeah, for a laptop. I want you to envision this. This is going to be a real thin battery. This is actually kind of what the batteries look like. They are real thin. They don't have about the thickness of twice the thickness of a piece of chewing gum. But anyway, that's what the laptop battery looks like. Just looking at my screen right now to see if everything in there. I think I do, yeah. Anyway, they make this, what is the name of this company? They give us a name. They make laptop computer batteries. I mean, they put a label on here, and it'd stick in there, but it'd only be about, I don't know, 2 or 3 millimeters thick. They've been having financial difficulty for some time. The company, and by the way, it says it has erratic sales. Erratic means they're going up and down. The sales are going up and down. The company's contribution format income statement for the most recent month is given below. So for the most recent month, it looks like this is their sales, their variable expenses, contribution margin, fixed expenses, and net operating loss. They lost money. By the way, do you see they sold, it looks like they sold 19,500 of these batteries. So 19,500, and they're selling them at $30 a piece. So 19,500 times 30 is going to be. All right, this camera powered down, I don't know why, in the middle of my lecture. But I'm trying to pick it up right where I left off. I was saying 19,500 times 30 is going to be $585,000. But they didn't give us all of this information. But we can do the same thing and say, well, let's get, they gave us the $30 per unit, but the variable expenses, they just gave them to us $409,500. Let's take the $409,500 and divide by, again, 19,500 units. And that will give us $21 a unit. That's the cost to make the shirt, the materials and the labor. And then let's take the $175,500, which is right here, and divide that by 19,500 batteries. That's what we're selling here. We get $9. And the fixed expenses, we're not going to do anything with those because, again, we usually leave them in total. And again, usually I told you, whenever you solve a problem like this, the easiest thing to do is always get your total, which usually your company will provide that to you. A company's going to have the total numbers, but get it per unit. And we know, again, that each unit, again, these batteries, the battery, again, I drew a picture of it. If the battery sells for 30, it cost us 21 for materials and labor. That gives us $9 in contribution margin. Every time we sell a battery, we get $9. And the $9 goes towards covering fixed costs and then profit. But do you remember, we're losing money right now. Then the next column you get is, again, a percentage column. The percentage column, again, just figure out that out of 100%, where does your money go? Well, $21 of every $30, 21 goes to variable costs. Again, if you simply just take and say, I want to know what percentages it is of 30. $21, what percentage is of the 30? Well, 3 times 7, it's going to be 70%. So 70% will be the percent of variable expenses. How about, again, the contribution margin? Well, 9. What is 9 of 30? 9 of 30 is 3 times 3, that's 30%. So we know, again, that every time we sell one of these, 70 cents of the money we lose, 30% of the money is what we get. Now it asks us, compute the contribution margin ratio and its break-even point in unit sales and dollar sales. I actually did this in front of the camera, but the camera shut off. I haven't got used to using this camera, the video camera. But here was part 1, and I'm not going to rewrite it because I just wrote it a minute ago, but again, the camera was off. Compute the company's contribution margin ratio. We really already have it. It's 30%. Compute its break-even point in units and sales dollars. Well, here's the contribution margin ratio. Here's a little different way I did it, though. I just said, let's take the contribution margin and divide it into sales. Same thing here. 9 into 30 is 30%. Or 9 divided by 30 is 30%. 175 divided by 585 is going to still be 30%. I did it a little bit different. Break even. Do you remember how we're going to get break even? Again, just take your fixed costs. This is what you don't have. And divide it by what you get. You get $9 every time you sell a computer battery. The break even is a formula. It's fixed cost divided by the selling price minus variable expenses. But you see the logic in this. The fixed costs in this problem are 180. And the selling price and variable expenses, it's $30 minus variable expenses of 21. That gets you $9. So again, 30 minus 21, that gets you 9. How many times do you have to get 9 to get up to 180? Well, again, divide this is your contribution margin, basically. Divide it into the 180, and you know you need 20,000 batteries to break even. All right, if you know you need 20,000 batteries to break even, and see the logic in that. This is what you get. That's why the contribution margin is such a beautiful number. It's very pure. If I get $9, this is your positive, and I need to get rid of negative 180. How many times do I need to get a 9 to get 180? Well, if you divide it in there, you need 20,000 nines. After you get 20,000 nines, you can cover all those costs. They also ask us, would you get us the answer in dollars? We'll just take the 20,000 batteries, and multiply it times, do you remember? They sell for $30 each. So they sell for $30 each. That's $600,000 to break even. All right, now number 2. This is, again, I'm going to cover this on the test for sure. And on this, it says, I'm going to give you on the test scenarios, like 2, 3, and 4. This scenario, it's a hypothetical, really. The president believes that if he or she increases advertising by $16,000, that it will result in an $80,000 increase in sales. The president says, if I'm right, what would be the increase or decrease in income? Okay, so 2 things, not too bad. The president's just saying, hey, if we increase advertising 16,000, I think sales will go up by 80. Is that a winning scenario, hypothetical? Well, the 16,000 is absolutely just an increase in fixed costs. And the $80,000 of sales, you don't get all of that, remember? Every time a sales dollar comes in, you only get 30 cents. So we can answer this pretty quickly by just saying, all right, let's just do it this way, bad and good. The bad, the fixed costs are going to increase by 16,000, that's advertising. But the good is that $80,000 of new sales will come in. But do you remember, we never get every dollar of sales. You remember that, again, every time we get a dollar of sales, we only end up with 30 cents on the dollar? So let's take those new sales dollars, and again, take the 30 cents and say, I'll get 3 times 8, I'll get $24,000 after I cover all my variable costs. That's what I end up with. That's your 2 changes. There's the bad, the 16, the good. Let's add them up. By the way, this is incremental analysis. I'm not going to recast the whole income statement. By the way, if you want to see the whole income statement recasted, go to my notes on Moodle. The notes on Moodle show you the whole income statement recasted. This is a shortcut. I think it's easier to do it this way. But we know that, again, $24,000 more in income, $16,000 in costs, we're ahead by $8,000. That's your increase in income. Now that's what they ask for, and that is the answer. What's the increase? On the test, what if I would have asked you, what is the new net income? Well, if we're losing 45, and we happen to make 8 more, what are we going to do? We're already at negative 45. Add a negative 45 to a positive 8. A negative 45 to a positive 8, you're going to end up with $3,500 positive income. So the test, be careful, I might ask you, what is the new net income? The new net income would be a positive $3,500. I'm not going to write that on the board because that's not really the question. Now let's do 3. And I got to change the angle of the camera to capture the other side of the board. And let's move it over here. All right, 3. I want to get my markers and stuff. This is part 3. And in part 3, it says refer to the original data. That means, again, this. This was the original data. The sales manager is convinced that a 10% reduction in the selling price, you can't quite see that, but the selling price. You can always open your book when we do these. If you want to, open your book and read along. But a 10% reduction in the selling price combined with an increase of $60,000 in advertising budget will double, that says D-O-U-B-L-E, will double unit sales. If the sales manager is right, what will be the revised, now this time they asked for the revised net operating income. They want the new net income. All right, I could use incremental analysis on this, but I'm not. just because this one has three variables here. One, they're going to reduce the selling price, increase advertising, and double sales. That's three variables they're going to change. A lot of times I think when you get three variables, students prefer it when I just recast the income statement. But in real life, I wouldn't. In real life, I'd use incremental analysis. If you go look at Moodle, at my notes, you'll see incremental analysis. Well, yeah, I better recast the whole thing. All right, let's just do it this way. Sales less variable expenses gives you contribution margin. Take out the fixed, and you'll get new net income. All right, do we agree sales? They say that sales are going to double. Do you remember sales were 19,500? So sales, if they double, we're going to have 19,500 plus another 19,500, which is actually going to be, that's going to be 39,000 batteries we're going to sell. We're going to sell them now. Again, this is tricky. It says the selling price, we're going to reduce it by 10%. So it's going to be $30 minus 30 times 10%. 30 times, that's $3. So we're going to take this times the selling price minus, we're going to give everybody 10% off. So that's really going to be 39,000, actually 39,000 times $27. Because again, that's going to be the new selling price, which is, I don't have any idea. Anyway, 39,000 times $27, $1,053,000 is our new sales. What's our new variable expenses? Well, it's going to be 39,000 units times, now they didn't say they were going to change variable costs. They said they're going to change the selling price, they're going to change the fixed cost because that's advertising. But they didn't say they were going to change anything, so it's 21. So take that times 21,000, and that will be equal to 39,000 times 21 is equal to $819,000 of variable costs. And there's many ways to do this that are better. I'm telling you, I think I'm kind of doing it the worst way, but you guys can look at my notes in Moodle to see the shortcuts. The contribution margin is then going to be $234,000. Okay, so there's your contribution margin, 234. The fixed costs are still going to be 180,000, but do you remember that he said we're going to increase advertising by how much? $60,000. So it's going to be $60,000 they're going to increase. That will be $240,000. So there's the old fixed cost plus the new advertising. The net income will be, well, 240 is negative, 234, that's going to be $6,000 loss. So, on part 3, they ask, what will be the revised net operating income? That is part 3 right there, $6,000. Should we do it? I know I'm stepping out of the view camera, but you know where I'm going. I'm not disappearing over there. Let me just check and see. I'm going to tilt this just a little bit more. Should we do it? Well, if we were losing $4,500 a month, we're now going to be losing $6,000 a month. And we're going to be doing a lot more work with all that advertising. It doesn't look like, initially at least I'd say, whose idea was this? The sales manager? You might tell the sales manager it doesn't look like it's going to work, so it's a bad idea, we're going to lose money. In part 4, which is the last part we're going to work, again, part 4. In part 4, it says refer to the original data. The marketing department thinks that a fancy new package. Now you can't see all of it, but they think that there's a fancy new packaging and they're going to put it in a fancy new package, and that package is going to cost, I believe, 75 cents. All right. Let's see, I'm just going to check my notes to see if that's what it does cost. Yeah. They say that again, the marketing department says, let's add a fancy new package that costs us 75 cents more. And also, they do say in this fourth part, they want to make a profit of $9,000, I think it's $75. Let me check that. $9,075. Nope, I'm wrong. $9,750. $9,750. So in this part 4, it says, refer to the original data. The marketing department thinks that a fancy new package, again, that costs 75 cents more, will increase sales, and they also want a profit of $9,750. And they ask you, in this one it's kind of odd, I don't really think it's a good question, I don't think part 4 would be a good one for the test, but they really say to you, what's the new, how many units would you have to sell? How many units would you have to sell to, again, get a profit of $97.50? So again, in 4 it says, you know, the question is, how many batteries to get, how many batteries do you have to sell to get a profit of $97.50? And remember, again, you're going to increase your cost 75 cents. Well, you can go back and use the break-even formula for this. Do you remember break-even is equal to, again, fixed costs divided by the selling price minus the variable cost. All you have to do is change this formula ever so slightly and say, if you want a desired profit, it's equal to the desired profit volume. Same formula is equal to the fixed cost plus the profit you'd like, divided by the exact same thing, selling price minus variable cost. You see, this is really just saying, all right, before you just wanted to break even, so you're just trying to cover fixed costs. Now, we're going to try and cover fixed costs and profit. Okay, let's pick up where I left off just a minute ago. I'd said in part 4, remember again, the marketing department thinks that a fancy package that costs 75 cents more is a good idea. They also specify that they think they can make a profit of $9,750. So that's the question. How many units will it take to make a profit of $9,750 in part 4? Well, you can use the exact same formula. You can use the break-even formula. Remember, break-even is fixed cost divided by selling price minus variable cost. But it's the exact same formula with just a slight departure. Instead of break-even, we're not solving for break-even. We're solving for desired profit volume. This is break-even volume. Now we want a desired volume, but it's a volume to make a profit. It still is fixed cost. You still need to cover your fixed cost, but you also want a profit. The only thing you're going to do is add money up in the numerator for profit. It's still selling price minus variable costs, and if we do that, again, you're going to get, in this case, let's do it, desired profit volume is equal to fixed costs of $180,000 divided by a selling price. They're still going to sell these for $30 each. But now, here's one little trick. It's not going to be $21 to make these. It's going to be $21 plus 75 cents. It costs $21 in materials and labor, but the new package is going to cost $75, so this is going to be $21.75 is your variable cost. If you do the math here, by the way, I did forget one thing. You also have fixed costs, but you want a profit. You want to add the profit to the numerator, $97.50. So I have the $97.50 to the profit. And when you do all that, let me just erase that. There's your numerator, the $180,000 in fixed, your desired profit, minus, again, this is basically your selling price minus your variable cost. This is going to be $189,750 is what this company desires. They're only going to be making, now it's less. They're not going to make $9. Remember, before it was $9. Now they're only going to make $8.25. And this is going to come out to be, the answer, if you divide that in there, I think it comes out to be $23,000. The answer comes out to be 23,000 batteries to get a profit of 9,750. I know I'm standing in the way, but again, this is the desired profit volume. To get that, let's erase that, desired profit volume, you're going to need 23,000 batteries to get a profit of 9,750. So you can use the exact same formula again, whether you're solving for break even or just, that's a volume, break even volume or a desired profit volume. You can use in the numerator. Really, the only thing you're going to change is your numerator for the profit. And then it depends on the problem. If your company is changing one of the price or the variable cost, you're going to have to change it. Anyway, I think that's the end of this problem. And I'll double check that just to make sure. I think that's 189,750 divided by $8.25. Yeah, that's 23,000 batteries. And that is the answer. That's the answer to part 4. All right, on the test, I'm going to give you, on the test, something very similar to this. I think I'm going to give it to you in multiple choice. I'm going to give you a header with a problem like this. If this company is having erratic sales, they're trying to decide, they're trying to brainstorm ideas, something to come up with to raise their profits. I'm going to run you through scenarios. I'm also, if you work some of the earlier problems, I'm going to ask you to calculate degree of operating leverage. Do you remember that? Degree of operating leverage. We did that in an earlier problem. I'm going to ask you to calculate, margin of safety. We did that in another one. I'll also ask you a scenario where I say, again, like when we had in the previous problem, 516, where we solved, I'm going to give you break-even. I'm going to say, what would happen if we know we can only sell? In this case, I don't know how many batteries were said. Let's say 23. Let's say if you know you can only sell 21,000, and I give you fixed costs, I'm going to have you solve for selling price. What, again, if we know the volume is going to be less, what do we have to do to the selling price? Or you could, well, let's just say that, so I'm going to give a hypothetical. That's in problem 516 where we use cross multiplication to solve for that. Anyway, though, this is the end of chapter 5. And now we move on to chapter 7. Chapter 7 is going to be on, let me see, that's going to be on ABC, activity-based costing. Let me see if I can pause this, and I'm going to erase the board. I don't know. Nope, doesn't appear that I can pause. All I can do is start and stop. All right, I'm going to stop this, erase the board, and pick it up and start chapter 7 and lecture on that a little bit. That'll be the next video.